Good morning. Today is the 1st of November. It is Tuesday, 2022. Only 2 months left in the year. It's the final stretch right now. I'm flying solo. Andrew is on a plane. Tom is otherwise indisposed. But Uber stock today, we'll start right there, is up 10% pre-market. They came out with earnings that, frankly, I didn't think were all that great. They had lower bookings than expected. But their revenue did come in higher than expected, and that was because their take rate is higher. So, for example, on their mobility division, which is what the traditional Uber that we all know, they're taking 27.9% of that booking, and they're just pocketing that money. That's up from 22.3%. So really increasing their take on that. So almost by 25% in terms of what they're taking versus what the driver takes. And same on delivery. Their take rate's up to 20.2%. That's up from 17.4%. So ultimately, you put that into context of numbers, and you have users up 14%, the number of trips up 19%, bookings up 32%, and revenue up 81%. And that's allowing them to actually generate some free cash flow. So Uber is actually generating more cash now. They're not burning cash like they were, but it's coming at the expense of their overall user base. You did see trips not quite meet expectations, bookings not quite meet expectations. Interestingly, though, as they look into the fourth quarter, they're not really seeing much of a deterioration in the consumer just yet. They still see bookings up in the mid to high 30s on the mobility segment, and delivery even bookings up in the mid-teens. So that's very interesting to me, that the bookings for delivery can still be up in the mid-teens, even though the amount that people want to shop for Uber Eats, for example, is down. So they're flying in the face of that. And presumably a lot of that is due to inflation, but they didn't break out the inflation component of that versus the number of trips component piece of that. So that'll be something that I'd be watching on the conference call. The conference call is happening later this morning. Elsewhere, we also had big earnings from some tech names and some pharmaceutical companies. Beginning with the tech companies, NXP Semiconductor said that their mobile and consumer divisions were pressured by the macroeconomy, but industrial and auto were actually relatively resilient. And this was a bit surprising to me because Texas Instruments said that there was broadening weakness in the industrial sector. They are still supply constrained, but they're nevertheless cautious in the medium term due to macro uncertainty. So the conference call is ongoing right now. I was not surprised to see the consumer-related weakness, but I was a little bit pleasantly surprised to see the strength in the industrial sector after Texas Instruments had reported earnings. Arista Networks reported very good results, probably the cleanest beat of any of the tech companies I've seen so far. They beat on revenue, they beat on earnings per share, and they also guided up well above street estimates. And I think this bodes fairly well for Cisco as they get set to report earnings later this month. Pharmaceutical companies, this is where it starts to get very interesting. You have Pfizer up about 3% pre-market. They actually raised guidance on revenue. This was all due to the COVID vaccine Comirnaty. They now expect $34 billion of revenue from that, up from $32 billion. Paxlovid was reiterated at $22 billion. You put those together and you're at $56 billion. That's more than half of Pfizer's $100 billion business. So more than half of Pfizer's revenue is generated purely from COVID drugs. So Pfizer is a very cheap stock right now. It's trading at about 7-8 times earnings, which is highly attractive relative to the market multiple, about 14 or 15 times earnings. So you're getting about half price, but that's because half of the revenue is coming from this COVID-related thing. And that's something that is important to remember when you're thinking about buying Pfizer. We do own Pfizer. This is a nice little move that we're seeing, but they need more drugs in their pipeline in order to really generate this going forward. And I don't know if they'll be able to just flip the switch on that. Separately, Eli Lilly also reported, this is the company that has that weight loss drug that's right now indicated for diabetes, but they're looking for a weight loss indication on it. And their stock is down a little bit. Their revenue was lowered, similar to Pfizer, due to foreign exchange. They didn't have the COVID boost, though, that Pfizer did. So Pfizer and Lilly were actually extremely similar, except Pfizer gets the COVID boost now, and Lilly gets the Mounjaro, the weight loss boost, later. Now, I actually think that Lilly is set up better than Pfizer going forward. And I think that ultimately the market will sift through that and sort that out. Right now, Eli Lilly is down 2% pre-market. I think expectations were a bit too high coming into the number. That doesn't change the thesis. Mounjaro revenue beat estimates by about 25%. Revenue came in at $97.5 million. Estimate was $80 million. That's really good news. And I think that the momentum there has been sustained. The only issue is foreign exchange, hit revenue, hit earnings per share. They also had incremental headwinds from R&D milestone charges, and that was the same for Pfizer as well. So Pfizer and Lilly, very similar quarters. Pfizer gets a boost today because of COVID. Lilly gets a boost going out into the future due to Mounjaro. My money's with Lilly long term. But it wasn't those two pharmaceutical earnings this morning that was the real headline. The headline grabber was Johnson & Johnson. Johnson & Johnson bought this company called Biomed at $380 per share. This is a publicly traded company. The deal is worth about $17 billion. It's a 50% premium to where the stock was trading, and it's going to be done all in cash. This is a big deal, even for a company like Johnson & Johnson. Biomed provides a lot of heart medical technology, and they also attach this $35 non-tradable contingent value right associated with the deal. That's probably not going to be worth all that much in today's dollars because the milestones are dated into 2027 and 2029. So I wouldn't put too much value on that. So just think of it as a $380 deal for a stock that was trading at $250. $380 deal, stock that's trading at $250. It's not going to be accretive until 2024. But it does diversify Johnson & Johnson's medical technology business. Johnson & Johnson's medical devices business has primarily been focused in the past on spine, knee, hip, those type of orthopedic surgeries that don't really have that much growth and have a lot of pricing pressure. This gets them away from that and gets them focused on a more higher growth segment of the market. And I think that is good for Johnson & Johnson long term, especially as they get ready to focus on pharmaceuticals and medical devices and spin off their consumer business next year. Nevertheless, this is an extraordinarily high premium to pay. The stock is down a little less than 1% pre-market, and I'm surprised it's not down more, because in this market, I would have expected investors really to reward Johnson & Johnson for holding on to cash rather than spending cash at a 50% premium on this other business. Moving on to energy markets, there was a big speech last night that was touted, but there was actually relatively little teeth in it when all was said and done. President Biden, flanked by Treasury Secretary Janet Yellen and Energy Secretary Jennifer Granholm, said that it is ridiculous how much energy companies, and especially energy producers and refiners, are making in this current market. And I don't, there are two arguments here. One is that these companies are monopolies and should be regulated, in which case antitrust laws should take care of that. The other argument is that they are colluding, again, which antitrust authorities should take care of that. And the final argument is that it's not a market, but the problem is they are price takers. It is a market as a commodity-driven price, and these companies are making the money dictated to them by the market. And so I don't really have an issue with that. If you want to incentivize production, provide a long-term solution set to increase production long-term. At the end of the day, investors value return of cash. That's partly due to the macro environment and partly due to the fact that they don't know how long these wells will be allowed to operate. So why drill more wells? And so that's the issue that you have in energy markets. And I actually expect energy markets to be upwardly mobile It's going to be helped by the government's underlying $70 bid per barrel bid in the market as they look to replenish the Strategic Petroleum Reserve. And it'll also be helped by supply reductions from both OPEC and the supply reduction coming from the end of Strategic Petroleum Reserve releases. So the problem is it's not a variant view, so it's not a compelling opportunity, but I do think that energy prices will be upwardly mobile going forward. We have more news out of the Bank of England this morning. They are going to be the first major central bank to begin selling bonds. They plan an auction of the first $750 million of short-term maturities. The results are due at 3 p.m. today. This is different than the quantitative tightening that we're doing in the United States. In the United States, we have a bunch of bonds. The Federal Reserve owns a ton of treasuries, mortgage-backed securities. And what they're doing is they're letting those run off. So as the bond comes due and gets paid off, Federal Reserve says, thank you very much. I'm not going to reinvest those proceeds. Boom, that's done. That's off the balance sheet. And that cash has been canceled. What the Bank of England is doing is they are actively in the market. They have their portfolio. And rather than waiting for those bonds to roll off, they're going out there and saying, we want to sell these bonds right now in order to get these bonds off the balance sheet. That's much more aggressive central bank policy than what we're doing in the United States. So that's something to watch going forward. I call it super QT. And to Bank of England's credit, they have taken a very activist approach here in trying to address inflation. They've been the one bank that has actually accurately predicted inflation and been rather calamitous in saying to the people where inflation is going. The Federal Reserve prefers to stick its head in the sand. The ECB prefers to do that. The Bank of Japan is completely not there. But the Bank of England is actually trying to take an active approach. I respect them for that, but it's going to be tough sledding for them going forward. Today in the United States, we have the JOLTS job openings report coming out at 10 a.m. The estimate is that falls just a little bit. The number of job openings falls just a little bit. If you think back to last month, this was one of the first items that got people thinking that the Fed was going to pivot and slow the rate of interest rate increases. I don't expect that narrative to necessarily remain the case today, but it's something we're going to watch. ISM manufacturing also comes out at 10 a.m. The estimate there is for a little bit of a deceleration in the underlying economy, but an acceleration in prices paid. That's expected to go from 51.7 to 53.0. The commentary is going to be interesting, but the headlines will likely be the most key to the market. If we get an upward revision on those prices to something like 55, 56, that could really bake in some negativity for markets as people think that the Federal Reserve is going to go faster rather than slower. And that all kind of leads up to the discussion on the Federal Reserve meeting tomorrow. Right now, the thinking is they'll raise by 75 basis points and then between 50 and 75 basis points in December. But the important piece, I think, really going forward is going to be the guidance for 2023. Currently, the market is pricing in 2 to 2.5 rate hikes in 2023. That's just 50 to 75 basis points beyond what they're going to do this year. And again, we're about to hike by 1.25 to 1.5% in the last 2 months of this year. So to think that they're only going to hike by half of that the entirety of 2023 is a little bit foolhardy, I think. And I think that the Federal Reserve's number one job, and I think that Jay Powell's going to introduce this tomorrow, his number one job is to increase the expectation of Fed rate hikes for 2023. I ultimately think that this number could be not 2 or 3, but 7 to 10 rate hikes next year. And I think that's the next bogey the Fed needs to attach. I expect they'll begin it tomorrow at the press conference. And I expect a pretty dour tone from Fed Chairman Jay Powell. Finally, the markets have been helped a little bit this morning by some posts on Chinese social media that they're relaxing the zero COVID policy. That has not been substantiated by anyone, but the Hong Kong stock market was up 7% overnight. So we're keeping an eye on that. I don't really have any edge on that. I'm inclined to say it's probably a bit of fake news, but it's something that's playing into the market. So I thought I would bring it up this morning. With that, have a great day. We'll be here tomorrow to talk about what happened with the job openings report and the ISM manufacturing report, as well as to get Tom's thoughts on the Fed meeting later tomorrow. Thank you.